Welcome back. We have a couple pieces of economic news to talk about, and we're going to talk about a warning sign and a very positive sign as well. First off, personal consumption expenditure, that's an inflation number, rose 0.4 versus, I believe, 0.1, better than expected. Inflation is still marching higher. Durable goods in April rose 1.1% versus a negative 1% expected. Now, the increase was largely due to military and business investment. Excluding transportation, orders fell 0.2%. Here's the durable goods in green versus the yellow S&P 500. Durable goods continues to rise. Now, if you remember last month's report, it was positive, but only due to a large Boeing order. We're going to see in a moment the similarity with last month's report and this month's report. Here in yellow, we have durable goods excluding transportation. You can see the line kind of tick down, but the overall durable goods is rising. So if the overall durable goods is rising, but then you take out transportation, it falls. What does that tell you? It means transportation is one of the stronger parts of the overall report. Here's durable goods ex defense in yellow as well. That fell while the overall report rose. So if you take out defense, if you take out transportation, durable goods does not look so good. Now, as a reminder, durable goods is a measure of those products that are designed to last more than 3 years. Cars, washing machines, computers, appliances, anything of that nature. Here's durable goods defense. Nice chart. The yellow shooting much, much higher versus the green in the S&P 500. The defense part of durable goods is definitely one of the stronger points here. Here's durable goods versus the PCE, which is the inflationary measure of durable goods. It's pretty much in line. Not a lot to report here. Here's durable goods transportation also shooting higher versus the green which is the S&P 500. So again, to recap, durable goods transportation up. Durable goods defense up. Here's durable goods that's in blue. That's the overall report. The red line is WHR, Whirlpool stock. They make washing machines, dishwashers, things like that. Stock's not doing so hot, which really makes sense based on the overall report. What part of durable goods is working? Transportation, defense, apparently not washing machines. And there's a lot that we could really look into this, that the washing machines, dishwashers, these home goods are closely linked to the housing market, which on all accounts doesn't look so strong these days. So it makes sense that the Whirlpool stock would be down versus other, parts of durable goods which are performing better. Again, such as transportation and defense. So we hope we can use this report to, maybe manage our portfolios or find trading opportunities, looking for stocks that run parallel to the strong parts of these particular reports. Now, here's the warning that we spoke about. 1 month T-bill up 7 basis points today. 2 month up 3 basis points. Notice the 10, 20, 30 going down. Now, that's not big moves we're talking about here. 3 basis points in either direction is not a big deal. But take a look at the overall trend. This is where current U.S. Treasuries stand. For the first time in a very, very long time, 1 month T-bill is above 6%, 6.02. That is huge. 2 month at a 5.47. The 1 year's at a 5.25. Notice the 10-year at a 3.80. The lowest yield available on our spectrum are the 10-year treasuries. We spoke about this the other day. The bond market's giving us a very important signal. I think it looks very similar to the signal that we saw in 06 and 2016. Now, we don't know which way, obviously things are going to turn out, whether it's in 2007, 2008, or a 2017, 2018, or maybe beyond. But the similarities are eerie. It's just a couple of videos ago that we took a look at the similarities between current treasuries and those historic periods of time as well. So 1 month T-bill at a 602. And again, the signal this is telling us is that at the moment in the immediate future, that's conveyed by the short-term maturities, we expect interest rates to continue to remain high, maybe even go higher. Long-term outlook, not so good. 1 month change in T-bills up 34%. The rest of the market barely moving at all. And if you consider the fact that the Federal Reserve is, at least on all accounts, on most accounts, it looks like they're going to continue to raise interest rates. The question is, why aren't the longer term maturities rising as well? The 10-year bond is only up 6% in yield. The 3-year is only up 10%. The divergence, the disagreement between very short-term and medium and long-term maturities tells us the whole thing. The bond market expects higher rates, but only in the near-term future. So we may ask, well, what's in the long-term future? Well, I think the bond market's telling us that as well. The black dotted line at the top is a 1 month T-bill, and the blue histogram bar, by the way, is the S&P 500. For some reason, the stock market really likes, at least for the short term, the optimism out there. So I think that's maybe one of the reasons. There's a lot of things going on, also, political crosswinds as well. But at least at the moment, the market likes what it sees. Now, 10-year bond is in blue. The 1-year treasury is in red. The histogram bars at the bottom show us the divergence. This is huge. A 145 inverted yield curve, a 1.45% difference, where the 1-year treasury bond is at a 525, the 10-year is at a 383. This is a almost or right around 150 basis point divergence between the 1-year and 10-year. Take a look what we saw in 2007. At the most, we saw the red line is a 1-year, the black line is a 10-year. The largest divergence we saw when the 1 was above the 10 was all the way back here. This shows us almost nothing. 50 basis points, half of 1%. The current inverted yield curve is 3 times that amount. Take a look at also, this is 2007. Well, okay, here's 2000 even. This is the rate of change between the 1-year and the 10-year. The 10-year's in black, the 1-year's in red. And we can see here the black lines. That is the black line over here. That's the rate of change. That's how much it's dropped during the same period of time that the 1 month has dropped precipitously more. Meaning that the divergence, although it was dramatic, and this is in the year 2000, 2001, and 2, is far, far greater now than it was in 2000 or in 2007. So certainly that is a huge warning sign. The divergence between current situation, status quo, and future expectations. Now, we don't want to be all doom and gloom. There are positive signs to this market, and that's on a technical basis. We take all the economic reports and all of our analysis, put it aside. What do we see here? The black dotted line is the S&P 500. We have a number of moving averages. The red line is a 10 simple moving average. The purple is a 20. Yellow is 50. Blue is 90. Green is 200. The S&P 500 is really above all of these different moving averages, and that's not something that happens very often. This is the 90-day past performance when the S&P 500 is up a specific or a certain moving average. When the S&P 500, and this is over 90 days, so we can extrapolate this out for the year, when the S&P 500 is above the 10 moving average, on average every 90 days, it means the market has given us around 4.6% return. When it's above the 20% simple moving average, 5.1, all the way up to the 200, which is a 6.1. So if we think that we can make around, on average, 6% return on investment as long as the S&P 500 is above the 200 moving average every 90 days for the year, well, that comes out to around 20%, a little bit more than that. But point being is that the longer term moving averages certainly have a very, very large significance. we may waver above and below the short term, but the long terms are really that much more important. Now, of course, if we waver below the 10 moving average, historically the S&P 500 averages around 1% positive over the last 90 days. If it's below the 200, that means trouble. It means we've gone down about 6-7% in the past 90 days. Now, moving forward over the next 90 days, the forward performance, if we see the market above the 200 moving average, it means the next 90 days we can expect around a 3%. Now notice it doesn't really have that much significance for the shorter term moving averages. The takeaway from this is that good, we're above the short term moving averages, but the long ones are really a lot more significant. And this is, of course, if we're below. Notice, if the S&P 500 is below the 200, it still shows us, on average, the market returns around a 4.5% return. So not as significant as we see over the long term. Now, this is what we see in terms of the stock market. The S&P 500 is a thin black line over here. The 90 is the blue line. The 200 is the green line. Notice a couple different things. Number one, the stock market is above both moving averages, as it is right now. The stock market is above the 90, the blue line. It's also above the green line. The 90, the shorter term of the two moving averages, the 90 is shorter than 200. That's above, which indicates a positive trend. If we know nothing else about the markets and we just wait for those periods of time, that number one, the S&P 500 is above its moving averages. Number two, those two moving averages are in line, meaning the short term is above the long term. That indicates a strong uptrend is intact, such as we saw in 2015. And if we were, for example, to employ a buy and hold type of strategy, say, okay, we're going to buy as long as the 90 stays above the 200, we would have been able to get in the S&P 500. This is 2015, 2016, around 2000. Well, that crossover did not occur until we saw S&P 500 around 2,800, 800 points in the S&P. We had a positive crossover again around 28, and that brought us all the way up to around 3,200. Again, we had a pull down in the market in 2020. We look for the crossover again, and we see a rally in the S&P 500 from 32 up to 47 and change. So why don't we all just use a buy and hold strategy when the stock market is above the 90 and the 90 is above the 200, or at least when the 90 is above the 200? And we very simply can. Of course, position sizes and stop losses and tolerance, and the fear factor, that may shake us out of a trade from time to time. But the fact of the matter is, at the end of the day, we look to the stock market price action for the ultimate signal, whether to buy, sell, hold, or wait for a better condition. And using a long-term trending type of approach certainly does get us into long-term, very profitable trades. And the fact of the matter is, right now, we are in that position. Now, it's not a buy recommendation because certainly there's a lot of things going on right now. And we just talked about a very scary bond market. But a very scary bond market is telling us, well, things could get worse in the future, but we really never know when. And if we want to use the moving averages as our final source of confirmation to tell us, okay, right now things look good from a technical basis, from a fundamental basis, we see dark storm clouds in the future. Okay, we can make money. We can, be long the stock market until the moving averages tell us to go out. As long as we have the discipline to get out when the technical analysis agrees with the fundamental analysis and they both give us a warning sign. As far as which stocks to buy, well, we're not going to make specific recommendations, but the durable goods orders, it did tell us there's two very strong components of that particular report right now: defense and transportation. So if we're looking for the strong elements in a very recent report, that would be the direction I think a lot of investors go. But we have a full economic calendar and many, many other things coming on next week. So we're going to be sure to update you along the way with any significant developments as well. We hope this has been helpful. We look forward to seeing you back soon.